Welcome to the Deep Dive, where we slice through the noise of the information age, take a stack of critical sources, and extract the precise knowledge you need to be thoroughly informed. Today, we are taking a deep dive into artificial intelligence, but, we're deliberately going to ignore the hype cycles.
Which is a good idea.
Right. And focus instead on measurable, quantifiable change that's happening inside a sector that pretty much defines tradition and regulatory caution, the insurance industry.
A very conservative space, typically.
Exactly. We have a single but very insightful source that details a tectonic shift. AI is moving past simple automation to fundamentally reshape the insurance sector itself. This isn't about incremental upgrades or a new app.
No, it's much bigger.
It's a total operational overhaul. So our mission here is to unpack this specific systemic trend. What does this move from the periphery, where AI was just a background tool, to the very heart of the business really mean? We need to figure out the real-world impact on efficiency, on the balance sheet, and most importantly for you, the customer who relies on policy coverage and, fast claim payouts.
That framing is precisely why this is so compelling. You hit on the key term there, systemic.
Right.
Previous cycles of tech adoption in finance and insurance, they were often about optimization, making an existing human-driven process maybe 10% faster.
A little bit better.
A little bit better. This shift, according to our source material, is fundamentally different. It's about AI becoming a core component, seamlessly integrated into the very logic and operation of major insurance giants.
Seamless integration. That sounds clean, but I'm guessing it's incredibly complex.
Oh, it's incredibly complex. And when we talk about that, we are talking about structural change, not just installing some new software.
Okay.
Imagine the operating system of a large company being replaced, not just, the word processor. This implies that the capabilities of machine learning and predictive analytics are now foundational to every single decision. From initial customer onboarding and policy pricing, all the way to fraud detection and claims payment. This level of embedding, it completely redefines how these firms operate. It dictates the pace, the consistency, and the precision of the entire enterprise. It's not just an incremental efficiency gain anymore.
No, it sounds like it's a competitive necessity.
It absolutely is.
Okay, so let's unpack the history here first, because insurance is, maybe surprisingly to some, a field that has been quietly embracing sophisticated data tools for decades, long before the current AI boom.
That's true, since the mainframe days, really.
Exactly. Their initial adoption was cautious, surgical, and largely hidden from public view.
Very much a back office affair.
So if we look at that initial adoption curve, where did this quiet revolution actually begin? The source material clearly points to the finance function within these insurance companies. That was the first area where automation really took hold. So why there? Why start in finance rather than, say, sales or something more customer-facing?
It's the perfect place to start, and for really understandable reasons. The finance function in any large regulated organization, and especially in insurance, is characterized by just massive volumes of highly structured, repetitive data tasks. Okay, so it's the low-hanging fruit for automation. It's the lowest hanging fruit, and it's also the ripest. This is the bread and butter of traditional automation and, basic machine learning.
So what kind of tasks are we talking about here specifically?
Think about the day-to-day work. You've got regulatory reporting, calculating reserves, which is hugely important.
Billions of dollars.
Huge sums of money. Then there's large-scale general ledger reconciliation, internal auditing, and just crucial data validation that supports all of actuarial science.
And these are tasks that demand absolute precision.
Absolute precision, consistency, zero error rates, and a sheer processing speed that just quickly overwhelms human teams. And crucially, all these processes rely on structured data, tables, fixed formats, which is the easiest possible input for those early automation systems to handle.
So the technology really started its career not as some visionary new product, but as a tireless high-speed clerk.
That's a perfect way to put it.
This confirms what the source says about the initial AI tech being a background player. It was just automating the inputs, checking the boxes, so the highly specialized, highly paid human actuaries and accountants could focus their time on
the complex stuff, the strategic analysis.
Right, instead of just verifying data entry.
Precisely. And in parallel with those high-volume structured tasks, the technology was also being used for what the source accurately calls niche modeling. This is where the early, more sophisticated algorithms were living.
Niche modeling, that feels like a critical distinction. It implies something sophisticated but very isolated, right? Probably confined to the actuarial department. Can we elaborate on what that looked like in practice?
Absolutely. So when AI was a background player doing this niche modeling, it might have been assisting in some highly specialized calculations. For example, maybe developing a proprietary model to predict the precise longevity of a very specific group of policyholders.
Say, non-smoking, self-employed individuals in the Midwest. A very specific slice. Or maybe it was modeling the precise probability of a catastrophic earthquake in a highly defined geographical area based on seismographic data that was just too complex for traditional stats methods alone.
So very powerful, but very siloed.
Extremely siloed. It was high-value work, for sure, but it didn't touch the customer directly, and it certainly wasn't driving the day-to-day decisions on the front line or in the core underwriting process itself.
So the data flowed into the model, a specialist gets the result.
And that result gets fed back into the traditional decision-making structure. The AI was a tool, not the process itself. So the AI was a highly sophisticated calculator for specific problems used by specialists rather than an operating system used by everyone. That brings us to today and the leap to core integration. Hashtag, the leap to core integration. And this is where the magnitude of this shift really comes into focus. We are talking about AI moving from that specialized niche utility, that powerful calculator hidden in the back office, to becoming a core operational pillar. Why is this move particularly fascinating, as our source suggests? What had to change for such a traditional industry to make this kind of commitment?
It's fascinating because it signals a fundamental change in institutional trust, in investment strategy, and even in regulatory acceptance. The jump from, supporting the finance team to driving the claims process is just immense.
It's a huge leap of faith.
It is. Moving a technology from a supporting back office role to a core critical component requires massive capital investment, a complete overhaul of IT infrastructure, which, for these insurance giants, is a monumental task.
I can only imagine the legacy systems.
Oh, they're legendary. And perhaps most importantly, it requires board-level confidence that this technology is reliable, that it's auditable, and that it's scalable enough to handle mission-critical, multi-billion-dollar decisions.
So if they're making this leap now,
it means the ROI is proven beyond any doubt, and the technology is finally mature enough to be trusted with the entire flow of the business.
Okay, I have to inject a note of skepticism here, though. We're talking about replacing or at least augmenting human judgment in areas like risk and claims with code. That sounds incredibly expensive, disruptive, and I imagine it's prone to some serious internal resistance.
For sure.
So if the AI is now deemed reliable, what does seamless integration actually look like on the ground? Does it mean the humans are gone, or just that the system is now dictating the action?
That's a crucial point. Seamless integration doesn't mean mass human extinction from the process. It means the human operator might not even realize that the AI is generating the core decision criteria. It's just built into the system interface. It's in the mandatory data inputs, the decision trees, the workflow itself. It becomes the default intelligence layer.
Can you give me an example?
Sure. Instead of a human underwriting manager reviewing a binder of documents, the AI system performs the initial risk triage instantly. The human manager only sees the output, the suggested policy premium, and the list of specific risk factors the machine identified.
So the human is now managing the exceptions.
They're managing the exceptions and the final decision. If the system is truly seamless, this pervasive influence spans all departments. It moves far beyond the finance office and into customer interactions, risk analysis, and claims payout decisions, all operating off a unified, constantly learning machine learning platform.
That concept, then, of redefining the fabric of the company is the ultimate takeaway here. When a business integrates tech to this depth, they aren't just putting a digital layer on top of an old system.
No, not at all.
They're redesigning their entire organizational structure and their operational flow around what the AI is capable of doing.
Precisely. Let's use a simple illustration.
Please.
The old claims process might have required 5 steps and 3 separate human handoffs over, say, 3 weeks.
That's about right.
The new process, where the AI can instantly verify a simple claim using external data feeds and its internal policy logic, reduces the required human action to 1 click, the authorization click, for maybe 80% of cases.
And the other 20%.
Those are the complex exceptions that get flagged for human intervention. The AI doesn't just process data, it dictates the speed, the precision, and the consistency of the entire enterprise. It is literally transforming the very fabric of day-to-day operations.
And that transformation must have immediate and massive consequences for their competitiveness and their financial stability.
It absolutely does. The source notes that this shift isn't purely about efficiency, although efficiency is a huge factor. It's also about fundamentally transforming how they interact with clients and how they manage resource allocation, basically in perpetuity.
So the integration is both a shield and a sword.
It is. It's a strategic shield against competitors and a powerful new tool for managing capital and risk exposure.
Yeah.
It really sets the stage for everything we're about to discuss in operational changes.
Okay, let's unpack this then. If AI is now a core component, if it's dictating the operational fabric of these huge firms, the impact has to be visible in their most crucial business areas.
It has to be.
And the source points to three critical areas of immediate, profound impact, which are basically the three pillars of any insurance company's existence.
Right, the core functions.
Those three areas are enhancing customer service, streamlining claims processing, and improving risk assessment. So let's start on the front line, the point where the customer actually interacts with the insurer. Enhancing customer service. Hashtag tag 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 A. Enhancing customer service.
In a service context, enhancement absolutely moves miles past just deploying, a frustrating first-generation chatbot that can only handle 3 pre-programmed questions.
We've all been there.
We've all been there. This is about delivering high-quality, high-speed, relevant, and even proactive information exactly when the customer needs it, sometimes anticipating their need before they even realize it themselves.
Okay, so what's the metric? How do you measure that?
Well, the measurable metric here is the delivery of faster and more personalized services. But how does AI achieve genuine personalization in this deeply regulated, data-intensive insurance context? It does so through instant hypergranular data synthesis.
Walk us through that mechanism. What kind of data is being synthesized and how fast are we talking?
We're talking about the system being designed to access and synthesize everything it knows about you simultaneously.
Everything.
Everything. It pulls your policy details, your entire payment history, your past claims history, any recent communication transcripts, and this is the key. It synthesizes the context of your current interaction.
What do you mean by context?
Are you logging in from a mobile device? Is it 2 a.m.? Have you recently searched their website for emergency water damage? It knows all of that.
Oh, okay.
By linking these internal silos instantly, the AI builds a real-time 360-degree profile of you.
Mm-hmm.
So the personalization isn't just knowing your name. It's knowing, based on your deductible amount, whether you are likely inquiring about a repair estimate or a total policy renewal. The AI doesn't have to ask 10 questions.
It just presents the most likely option.
Exactly. It presents options tailored to your specific situation and your known policy limits.
Let's contrast that with the old workflow, because that's a huge difference. If I call in after a storm, the old process required me to verbally input my policy number, navigate some complex phone tree,
The dreaded IVR.
wait for a representative, verify my identity again, and then explain my entire situation from scratch. That whole administrative friction process could take 10 to 15 minutes before any actual help was even rendered.
Right before you get to the problem.
The AI integrated system just flips that script. If
Yeah.
you call from the number on file, the system can immediately pull your geolocation, cross-reference it with known local weather event data, and identify the exact policy you hold.
So the conversation starts with a solution, not a question.
Precisely. The conversation starts immediately with action items, leveraging the AI's data synthesis. We see you are calling from a storm-affected area and hold policy X. Would you like to file a claim for hail damage right now, or are you looking for local pre-approved repair contractors? That is genuinely faster, and the advice is personalized instantly based on your specific coverage.
And that operational speed has a crucial secondary effect. It drastically improves resource management.
How so?
By handling the overwhelming volume of routine, standardized interactions with high speed and accuracy, the AI acts as an infinitely scalable frontline filter.
So it frees up the human agents.
Exactly. They're no longer spending 80% of their time on repeated identity checks or looking up policy numbers.
Yeah.
They can focus exclusively on the complex, the unique, or the emotionally charged interactions.
The situations that need a human touch?
The situations that require empathy, negotiation, strategic judgment, or deep expertise in some unusual policy clause. It ensures the most expensive, skilled resource, the human team, is deployed where they add the most value, which dramatically improves the efficiency of the entire workforce.
So the AI handles the mundane, high-volume tasks with machine precision, and the humans handle the high-touch, high-complexity exceptions. That sounds like a much better allocation of capital and
Well, it's a
expertise.
far superior model. Hashtag to be streamlining claims
Yeah.
processing.
Okay, moving from proactive service to what is the most crucial moment of the insurance contract, streamlining claims processing. This is not just a customer service issue. This is an absolute operational necessity. Claims represent the single largest cost center for any insurer, but they're also the primary mechanism for customer retention and satisfaction. Getting this wrong basically guarantees business failure.
This is where the efficiency mandate truly crystallizes. And it's where that investment in core integration pays its biggest dividends. Streamlining claims is crucial for the company's bottom line, controlling costs, maintaining financial stability, and for the customer, who just wants their resolution quickly and without any hassle.
Right. And the source mentions that AI contributes to more accurate services, particularly in the context of claims verification. This accuracy improvement is a direct defense against financial leakage. What does that accuracy look like when it's driven by integrated AI?
Well, historically, accuracy relied on manual data review and an adjuster's judgment, which, introduces variability and a lot of time delays.
And human error.
And human error, of course. Now, accuracy means the AI system is using rapid, multi-source data verification. For property claims, this could involve computer vision analyzing photos of damage against standard repair cost databases.
So it knows what a new roof should cost in my area.
Instantly. It's cross-referencing the stated facts of the loss against known fraud patterns and ensuring consistent application of the policy language across millions of cases, which minimizes that arbitrary human error.
Let's talk about fraud detection, because that's a huge one.
It's a massive cost. Historically, a claim might get flagged for fraud only if it hit a few obvious behavioral triggers. An integrated AI system, however, can detect highly sophisticated, even novel fraud rings by identifying minute, non-obvious correlations across thousands of unrelated claims.
What kind of correlation?
A pattern of repair shops, policyholder addresses, or shared banking information that no human team could ever synthesize across that volume of data in real time. This level of rapid verification happens in seconds, and it significantly minimizes the risk of overpayment, or what the industry calls fraud leakage.
That brings us to speed of delivery, which is probably the most tangible benefit to you, the listener. If the AI can verify the details, maybe processing input from drone imagery or telematics data from a vehicle, and apply the policy terms consistently, the processing time must just collapse. How dramatic is this acceleration?
It's transformative. For standardized low-complexity claims, which is the vast majority of their volume, we are talking about moving from a historical average of, say, 7 to 14 business days.
Or more.
Or more, absolutely, down to straight-through processing in under 48 hours. Or even real-time payment for verified minor claims.
Real time.
Real time. The AI manages this by automating the internal data transfer. It automatically generates the required regulatory filings, it calculates the final payment amount based on the policy contract stored in its database, and it initiates the fund transfer, often without a human ever seeing the file.
So that ability to offer near-instant approval or payment for simple, verified claims, that just dramatically shifts the customer experience.
It turns a point of anxiety and friction into one of quick, reliable resolution. And that is a massive competitive advantage.
And I'm guessing that speed has a profound cascading financial effect beyond just making the customer happy.
Oh, it does. Faster processing means lower administrative costs, fewer personnel needed to chase paperwork or answer "what's the status of my claim" inquiries. It also means quicker closure of the claim file, which improves overall operational fluidity.
And from a capital management perspective.
It means the insurer is better able to project and deploy its reserves. They're turning a historical cost center bottleneck into a highly optimized, high-velocity service delivery mechanism. They just move their capital faster and more efficiently. #C, improving risk assessment.
Okay, finally, we arrive at what is arguably the single most vital operational function of any insurance company, improving risk assessment. This is the absolute lifeblood of the industry.
It's the core of the entire business model.
Right. If an insurer can't accurately price risk, they cannot survive long term. They either overcharge and lose all their customers, or they undercharge and risk bankruptcy.
It's a razor's edge.
And we established that AI started here as a niche modeling tool, assisting actuaries with one complex variable. Now, with core integration, AI's role in risk assessment has exploded. This means systems are analyzing vast, complex, and crucially unstructured data sets in real time.
That distinction is the heart of the evolution. Niche modeling dealt primarily with limited, internal historical data, what they already knew. The current improvement in risk assessment means integrating and dynamically modeling external unstructured feeds.
So what kind of external data are we talking about?
Think about the complexity of the data now being ingested. You have IoT data streams from vehicles, telematics, or from homes with smart sensors. You have real-time, high-resolution satellite imagery, proprietary topography models, hyperlocal hazard data derived from predictive weather analytics, and even socioeconomic trends synthesized from external market data. Processing all of that instantly creates a dynamic, predictive underwriting profile that feeds directly back into their pricing decisions.
That sounds like a profound technological shift. Can you give us a concrete example of how this granular data changes a typical pricing decision, let's say for homeowners insurance?
Certainly, consider the difference between the old way and the new way of assessing fire risk.
Okay.
The old way might rely on a census tracts historical fire data in proximity to the nearest municipal fire station. This is static, it's broad, and it's very slow to update.
Right. It's an average of my neighborhood.
It's an average of your neighborhood. The new AI-integrated assessment uses real-time or near real-time data. It examines your property's specific roof material, which you can see from satellite imaging. It might know the age and specific type of internal wiring from building records. And it cross-references that with local fire department response times based on current traffic patterns using predictive analysis. It might even ingest local news reports about brush fire risks in that specific neighborhood. The result is a profile that is far more granular, precise, and dynamic. That precision is invaluable.
And that precision is what directly links improved risk assessment back to managing resources and improving the bottom line. Better, more accurate assessment leads to two critical financial outcomes, which you mentioned briefly earlier.
Yes, the two critical outcomes are risk mitigation and optimal pricing.
Let's break those down.
First, mitigation. Better risk modeling leads to fewer unexpected payouts because the risk was miscalculated. The insurer isn't caught off guard by systemic failures or rapidly developing localized hazards. They see it coming.
And second, optimal pricing.
This integrated AI capability allows for precise pricing strategies. The insurer can now price policies so accurately that they achieve what they call risk parity. And this combats the major industry danger known as adverse selection.
Okay, let's clarify adverse selection for the listener. That's a really important concept here.
It's fundamental. Adverse selection is the risk that if your pricing model is too generalized or inaccurate, only the high-cost, high-risk customers will find your policy economical.
And the low-risk customers?
The low-risk customers go elsewhere for a better price.
Yeah.
You end up attracting all the bad risk and shedding all the good risk. It's a death spiral.
So how does the new AI system avoid that trap?
Because it can create these hyper-granular profiles, it ensures that the premium accurately reflects the specific risk of that individual or that property. This allows the insurer to maintain healthier margins on all their policies while still offering competitive rates to genuinely low-risk customers.
So it's fair in a way?
It's much more precise.
Mm-hmm.
It transforms risk assessment from a statistical guessing game that relies on historical averages into a precise predictive science driven by integrated machine intelligence. It's the difference between using a blunt instrument and using a scalpel. So, now that we've established where the AI is being deployed in service, in claims, in risk, let's pivot to the larger financial and competitive consequences.
The big picture.
The big picture. Because these operational changes have massive implications for both the company balance sheet and the competitive landscape of the entire sector. Let's start with the immediate impact on the hard numbers, driving the bottom line.
Right.
The source explicitly notes that insurers are improving their bottom lines by embedding AI into their operational DNA. This is not, incidental savings. This is a validation of the core business case for this massive technological expenditure.
It's the definition of efficiency gains. And we're looking for more than just a vague affirmation of improvement. Can we break down the financial impact into specific categories of gain? I'm seeing it as a kind of dual benefit. Cost reduction through streamlining and revenue enhancement through better risk selection.
That's the perfect way to frame it.
Yeah.
On the cost reduction side, the cumulative effect of efficiency is just staggering. We are talking about the reduction of operational costs associated with manual processes. Things like reducing the need for administrative full-time equivalent personnel.
FTEs.
Minimizing printing and storage costs for physical files, and eliminating internal reconciliation discrepancies. All that friction.
But the bigger savings must be in the claims themselves.
More dramatically, yes, you have the financial benefits of reducing leakage. By using AI for superior fraud detection and consistent claims payout, So avoiding overpayment due to human error or policy misinterpretation, the insurer retains significant capital that would otherwise be lost.
What does that look like in real dollars?
A, a 5% reduction in claims leakage across a billion-dollar claims portfolio is a $50 million boost to the bottom line immediately.
That's a huge number. And on the revenue side, the superior risk assessment is directly translating into healthier profits.
Absolutely. Precise pricing prevents that adverse selection we talked about, ensuring that every policy written is profitable, or at least meets a specific margin target. And furthermore, the speed and accuracy in claims and service lead to higher customer retention rates.
Which is always cheaper than acquisition.
Significantly cheaper to retain a customer than to acquire a new one. The combination of cost savings, leakage reduction, and superior customer lifetime value due to retention is what validates the massive strategic investment required for this core AI integration.
This framing of the move as a strategic investment is important. Companies don't move mission-critical functions unless they see a guaranteed significant ROI.
No, the risk is too high.
This indicates AI has moved past the experimental stage and is now viewed as the single most efficient mechanism for generating superior margins and managing capital risk in the modern market.
The tires have been kicked. This is now the engine. #B, the customer experience transformation.
Okay, beyond the balance sheet, the ultimate output is service delivery. We need to focus on the direct, tangible benefits delivered to customers. Faster, more accurate, and more personalized services. This is where you, the customer, get to actually feel the benefit of the insurer's technological investment.
This is a critical point because the benefits are no longer hidden inside the back office. They are immediately experienced by you, the policyholder. The speed of resolution, the accuracy of the payout, and the tailored advice you receive represent a fundamentally superior level of interaction.
And critically, when you experience truly fast, accurate service, say, a minor claim resolved in 4 hours instead of 4 weeks, your expectations for every other service provider are fundamentally reset.
Not just in insurance either, across the board.
Exactly. This new level of service delivered by AI-integrated companies is actively setting expectations across the entire industry. This feels like an irreversible trend.
It absolutely is.
And that sets up a powerful market dynamic. If a market leader, thanks to their core AI integration, can consistently process 80% of standard claims in under 48 hours, the consumer will no longer tolerate the competitor who takes 4 weeks using antiquated manual processes.
I would think.
The gap in service quality becomes a primary, highly visible driver of customer churn and brand reputation.
Precisely. This means the AI isn't just a tool for cost optimization. It is embedded in the operational DNA, making better customer delivery the default product offering. It's no longer an add-on or a sporadic achievement. It's the core system itself, delivering high-quality, instant service. This shifts competition entirely toward who can deliver speed and precision most reliably.
I do wonder about the human side of that transaction, though. Doesn't this reliance on speed and automation risk dehumanizing the interaction, particularly during traumatic or complex claims?
That's a fair question, and it's where the resource management we discussed earlier becomes so vital. The AI is designed to handle the standardized, high-volume stress of the transaction quickly and accurately.
It takes the friction out.
Takes the friction out, so the human element, the empathy, the negotiation, the complex legal interpretation is preserved for that 20% of cases that actually require it. The irony is that by automating the simple, the insurer can afford to provide more high-quality human attention to the cases that genuinely need it most.
So the core AI actually improves the quality of the human-to-human interaction.
By removing the administrative distraction.
Yes.
#TANC, setting new industry standards.
That structural shift leads us directly to the final strategic implication. This transformation is actively setting new standards for the industry. Our source highlights that this isn't an isolated event, it is a broader trend where AI is moving from the periphery to the heart of business operations across all kinds of traditional sectors.
The broader context here is crucial. Insurance is a regulated, capital-intensive, and fundamentally risk-averse industry.
Famously slow to change.
Famously slow. If this sector, which moves slowly due to regulatory burden and massive legacy infrastructure, is successfully executing a total operational overhaul based on core AI integration, it validates the technology's capability to operate successfully in mission-critical environments anywhere.
It's the proof of concept for everyone else.
It is. This is AI transcending every traditional boundary and all that organizational inertia.
So what we're witnessing is the beginning of a competitive arms race, but it's driven by technological capability.
Exactly. The implications of AI setting new standards are simple. Non-adopters simply cannot compete. The gap is just too wide. A company clinging to legacy systems will find their expenses are inherently higher, their risk models are inherently weaker because they rely on limited historical data,
And their customers will be leaving.
and their customer satisfaction lags dramatically because their claim processing is slow. This structural disadvantage will inevitably force consolidation or collapse among the laggards.
The new standard is speed and precision.
The new standard is AI-driven velocity and precision in capital management. It shifts the competitive battleground from distribution and marketing to technological supremacy in operations.
And when we synthesize all these findings, from niche modeling to integrated core component, the core takeaway really emerges. AI in insurance is a testament to its ability to transcend traditional boundaries and redefine what's possible in everyday business functions. It means that seemingly immutable business processes, the decades-old procedures for assessing risk, underwriting a policy, or processing a claim, are in fact incredibly fluid and plastic when faced with integrated machine intelligence.
That's a great way to put it.
The operational ceiling for accuracy and speed has been permanently raised. This is not an iterative change, it's a paradigm shift in how capital is managed and risk is priced. Hashtag outro. What a profound deep dive into the operational machinery of an industry that, often feels invisible until you really need it. Let's quickly reiterate the transformation we've uncovered here.
Well, AI started as a specialized, quiet tool, automating the finance back office and assisting in some niche actuarial modeling
In the background.
in the background.
Yeah.
It has now moved into a seamless core function, transforming the three pillars of insurance risk assessment through granular real-time data ingestion, claims processing through rapid, accurate, straight-through processing,
And customer service.
and customer service through personalized, instantaneous interaction.
And that deep operational integration delivers the critical dual benefit. Improved financial performance for the company through efficiency, reduced leakage, and better risk management, and the direct delivery of faster, more accurate, and more personalized services for you, the customer.
It's a rare case where the technology benefits both the balance sheet and the end user simultaneously.
It really is. And here's where it gets really interesting, and where the implications of this deep dive extend far beyond the world of insurance. We've seen how AI successfully conquered a highly traditional, heavily regulated, data-intensive sector by demonstrating superior speed, accuracy, and operational capacity.
The blueprint is there now.
The blueprint for a total operational revolution is now established.
So we'll leave you with this provocative thought. If AI has successfully moved from the periphery to the heart of an industry as traditional and regulated as insurance, what major established sector one that hasn't fully embraced this core systemic integration yet will be the next one to experience this total operational revolution?
What's the next domino to fall?
Exactly. Will it be the fragmented landscape of modern healthcare administration, where data silos are just ripe for synthesis? Will it be large-scale, complex, global supply chain logistics, where real-time predictive risk assessment could save billions?
Or maybe even legacy public utilities where infrastructure management is so critical.
It could be. The blueprint is now established.
That is something for you to think about until the next deep dive, because wherever there is immense volumes of data and repeatable high-stakes process, AI is coming for the core operations. Thanks for joining us on the deep dive. We'll catch you next time.